Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, February 13th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the next trading day, which begins in about 30 minutes, and it's going to be an interesting one for sure. We got that CPI report out for January, and it was not good for the bulls. So we did come in a little bit higher than expected. The headline number on CPI was expected to come in at 0.2%, and it rose at 0.3%. And if we strip out food and energy, move to the core CPI level or number, that was supposed to come in at 0.3, and we actually rose 0.4. So what does that mean? Well, I can tell you what it means to futures. It means futures are taking a pretty big dive this morning. I can tell you, in my opinion, it is a temporary pullback, and it may be a pullback. It may not just be one little gap down. This may be the start of the mid-February to early March swoon that we tend to see, not only in election years, but typically throughout much of history. If we look back at the NASDAQ alone, the QQQ, well, actually not the QQQ, but the NASDAQ composite, the annualized returns for the first half of the first quarter, about 31%. The annualized returns for the second half of the first quarter, 0. So quite a disparity between how the NASDAQ performs in the first half of the first quarter versus the second half of the first quarter. And here we are, it's February 13th. We're getting very close to that middle part of the month. We got options expiring on Friday. Obviously now the Fed, which has talked about delaying interest rates, this certainly plays right into that theme. I think those who were expecting maybe a March rate cut probably dwindled anyway after the last Fed meeting, if I'm being honest. But those who still remain likely might get off of that position after this inflation print this morning. We do have one more of these CPI reports out before the Fed meets, so it's possible things turn and we're looking at something completely different 30 days from now, or roughly a month from now. But at least for today, the question is going to be, how low might we go on the S&P 500? Before we get into that, let's take a look at what happened yesterday. It wasn't a bad day, but it wasn't a great day either. Leadership was the big part that was missing. You won't see technology on the list of leaders here because technology was actually in the rear, bringing up the rear yesterday, the last or the worst performing sector, losing, I think, roughly 0.75%. But if we look at what actually happened and some of the leaders, let's go over those. Let's start off with the Dow Jones, which did finish up 125 points. S&P 500 was down 4, almost 5, and the NASDAQ was down about 80. So you can see bifurcated action, not exactly up everywhere. We were up early in the day everywhere, but then we saw some afternoon selling. And that's what enabled or created the weakness on the S&P 500 and the NASDAQ for the day. It was really the afternoon selling. Mid caps up about 1%. Small caps up nearly 2%. So we've seen small caps outperform now for about the last 3 or 4 days by a pretty wide margin over the NASDAQ 100. That completely reversed what we had been seeing up to date or year to date in 2024. Transports were flat, though. Still trying to make this breakout on the transports. The good news that has kind of come to light here of late has been, remember I was talking about the AD lines really weak on small caps and mid caps. Well, we've seen that turn to the upside. And so one of my first questions today, with the market looking like it's going to open weak, and I'm pretty sure within 26 minutes, unless a lot changes, we're going to open weak. I'll give you those numbers in just a minute. But with a strong AD line, we ignore gaps with any AD line. The AD line, if you know how it's calculated, and I'm talking about the accumulation distribution line. Sometimes I say AD line, everybody's thinking advanced decline. It's not what this is. This is the accumulation distribution line, and it's simply calculated based on where you finish in a trading day relative to your high and low for the day. Has nothing to do with where we closed yesterday. Doesn't matter whether we went down 3% or up 3%. The AD line ignores those gaps. It only concentrates on what we do from the opening bell to the closing bell. So for instance, today we're getting a big gap down. Not a great start to the day for sure. But literally the AD line doesn't care about this gap down. It cares only what happens after the opening bell. So if we open, let's say, we open down 2%, and we go down a little bit during the day in the morning, which is typical during a bull market to lose ground in the morning hours, come back in the afternoon. If that were to occur, the AD line is going to look at where we closed today relative to our trading range today. If we're above the center line, above the midpoint line, that means the AD line is going to go up, and that is going to be fueled by the amount of volume, which I'm sure is going to be pretty heavy today with a big inflation report out. So if we finish all the way at the high of the day, all of today's volume would be added, and you would see these AD lines really pop tomorrow or at the end of the day. If, however, we gap down and we continue selling off and you see a big red candle, heavy volume, then you're going to see the AD lines plummet. But it depends on what happens after the open. The gap down, today's open being down a couple of percent on the NASDAQ, actually more than that. I think close to 2% on the NASDAQ or on the I think it's like 2.75% on the Russell 2000 small cap, and then probably about 1.6%. At least that's where it was on the NASDAQ, but we'll check that out and give you those in just a minute. Transports, as I said, relatively flat, trying to get through that resistance area, but all of these AD lines now look very strong, telling me that there is intraday buying, which normally leads to higher prices. Let's see what happens today after this big gap down. My suspicion is that we're going to see weakness in the morning, that it's not just going to be a gap down and then buying all day. I'd love to see that. That would be very bullish. I doubt that we're going to see it. Simply, there's just too many other factors right now that look like we were primed for a pullback, and now we've got fundamental news to go along with it. Seems like this is going to be the big test for the bulls in the near term. And I do believe it's a near-term test. I do not believe it's a long-term problem. Big difference there. Utilities gaining 1.16% yesterday. That was your top performing sector. Also, energy up 1.1%. Materials up about 0.8%. Looking at the industry groups, furnishings up almost 4%. The durable household goods up 4.9%. And 3.9%, and renewable energy up about 3.8%. So there were certainly pockets of strength, but these are not the pockets that had been leading us in 2024 or even most of 2023. These are groups that had been taking a back seat, but came to light yesterday. Saw some really nice strength in those three areas. But you don't see technology on here. You don't see communication services. You don't see semiconductors. You don't see internet. You don't see software. All of those groups clearly taking a back seat yesterday. And probably, I would think, for the foreseeable future. But again, let's see how we trade today. I just feel like with all the other signals we've been talking about, and especially with options expiring on Friday and knowing that there are tons of in the money call premium, that all combined along with today's inflation print certainly increases the odds that this is going to be a little bit more than just an opening gap down. 10-year Treasury yield. Actually, before we get into the 10-year Treasury yield, let me give you those futures right now so you can kind of brace for it if you haven't already seen. The diamonds are down about 1%. And I'm guessing without looking any further, this is going to be your best index. The Dow down about 1%. The Spider down 1.4%. The QQQ down 1.8%. So it's dropped a little bit more. And then the IWM, which tracks the Russell 2000, down 3.5% now, 195.76. That's down $7. And if we look at the IWM, that 195.76 level would be down right at the 20-day moving average, which was 195.77. So all that work the last 3 days or so in the small caps going to get wiped out at the opening bell, apparently, according to where we are right now. And so let's see where we go from there. I mean, is this going to be one of those days where you gap down to the moving averages and you see a big red candle that just keeps dropping? That would remind me a little bit about August 25th, 2022, which was the Fed's, that was their speech, or Fed Chief Powell's speech from Jackson Hole, if you remember that. After it looked like we had bottomed in 2022, had a huge rally through August of 2022, and then August 25th, the next bomb was laid by the Fed. This, in my opinion, is temporary, like that was. But the question is, do we actually break down and go back down and really start to test the bull's metal? Or is it just a one-day gap down and then we kind of recover off of that? That, I think, bears watching, and really no way to know until we see how the action unfolds today. But if we do gap down below those moving averages and continue to sell off today on the IWM, that certainly would not be good news. And it kind of makes sense based on how the market has been trading. If we think about objectively what's been going on since the Fed said that, we're going to push back rates, or at least they nixed the idea of a March rate cut, saying that it was very unlikely and that we would be looking at rate cuts later in the year. They wanted to see the inflation numbers continue to come down. That was what the Fed said at the last meeting. And since they said that, some of the areas that would be impacted the most by a delay in rate cuts, like banks, like smaller companies that have maybe are looking for that cut in rates, maybe to spur business. Also, many of the large cap names, tech names, don't have borrowings. They have a treasure chest of cash. So they're not really impacted by, as long as the business is out there and they maintain their market share, the fact that they're going to delay interest rates really doesn't impact those groups as much. And that's the way the market's traded over the past couple of weeks since that Fed meeting. We've seen money, until the last few days, we had seen money rotating into more aggressive areas and larger cap names, like we had seen throughout 2023, or much of it till the fourth quarter anyway. But these last few days, it's almost like the market was ramping up for a dovish print on the inflation number this morning, because the last 3 days we've seen the banks do better. We've seen the IWM completely outperform the NASDAQ. So some things have taken place. We've seen transports move up close to that resistance area. So all of these things, to me, would suggest that the market was maybe anticipating that this inflation report was going to be nothing to worry about. And instead, we're getting the opposite. So those areas that had been bid up the last couple of days, now we're seeing that group taking the big hit, and a lot of those gains given back, which again, based on what we've seen, kind of makes sense. Just going back to where we were, really. Let's go ahead and keep moving on. Got the 10-year Treasury yield. So let's get an update here. We are breaking out to the upside. That was one thing when we got up to this 420 level. Yesterday, I was talking about it. We had a webinar last night, and also, of course, our weekly market report, which is a really comprehensive report that we send out to our members. Anyhow, what I've been talking about recently was this 420 resistance area on the 10-year Treasury yield, and the fact that we have been in this range. And what I was expecting was inflation, kind of like the market was pointing me to. I was expecting inflation maybe to come in at plus 2%, plus 0.2%, instead of coming in higher than expected, actually coming in a little lower than expected. And with that, I even said I thought maybe we'd see a big drop in the 10-year Treasury yield, perhaps back down to 4% or so. We got the opposite. We got the IWM collapsing. We got the, collapsing might be a little bit too much drama, but definitely a big down open to today. We've got yields going up because of the higher print than expected on the core CPI rate. And now, I mean, it's hard to say we're not in a short-term uptrend, because as far as I'm concerned, we came down, we went back up to that 50 period moving average. We set a resistance, that dividend or the interest or the yield resistance, if you will, 420, came back down close to 380. I mean, clearly we were establishing a trading range. And unless we have a big move back down later today in the yield, back down below 420, if we do, to me, that would be a head fake and very bullish for equities. But if we get this breakout here, to me, that at least sets us up for further move to the upside in terms of the 10-year Treasury yield. And we know that hasn't been good for stocks. So again, that leads me back to the point I made at the very open, where we've been setting up with a few signals saying that we could be topping when negative divergences. We got the options expiration and so forth. Now we've got another fundamental report that you can throw in that basket, along with the seasonal pattern, mid-February to early March. This is the period when we do typically see the stock market have a pullback, not only historically like all years, but in particular election years, presidential election years. That's something that we talked about. I know back at the beginning of the year, I won't give my whole forecast for the year, but what I said at the beginning of the year in Market Vision 2024 was that I expected that the S&P 500 in the first quarter could go up. I thought January we would test 5,000. I thought in the first quarter we could maybe get as high as 5,100. Got pretty close. And then I said we could go as low as possibly 4,550. Now, I don't think we're going down that low. I would say more like 47 to 4,800. But I think there's an outside chance that we could go down that low. That's what I had forecast for the first quarter. Now that we got not so great news on inflation, I think this could be the news that at least moves us in that direction. We'll see again how long it lasts and how low we go. S&P 500. So S&P 500 moving up. Did have a little bit of a reversal yesterday. Volume was kind of light though, but we're going to get a test today. We're going to see the S&P 500 moving back down toward that 20-day test. Do we hold it or do we not? If we don't hold the 20-day, you can see that 50-day is down below 4,800. With a negative divergence, you can still see that higher price, lower PPO in play. It's possible we're going to go down and get a 50-day test, maybe slightly below that. That would really spook the bulls in the near term. So that's why I'm saying 4,700 to 4,800. We had the recent lows. We got a double bottom right around 4,700. We got the 50-day moving average creeping up to 4,800. So when you go through a period where you get some bad news and you get a pullback, those are levels that could come into play. As I've said all along, I'm bullish. I'm still just as bullish today as I was yesterday. Give me 3 or 4 of these inflation prints like this that are above normal. Yeah, then we could have a whole different story. Personally, I think it's a blip. I think probably next month goes the exact opposite way, but we'll react in the short term to what we need to react to, which again, at the opening bell is going to be a lot of weakness. So S&P 500, again, maybe 20-day, possibly 50-day. I think probably going to get at least the 20-day. That's normal during just about any uptrend. And with the bad news and the fact we're so overbought, option expiration, that would not surprise me at all. And by the way, we have our Max Payne session for members later today at 5 o'clock Eastern. So if you're not already an EarningsBeats member and you'd like to come in and see just how far Max Payne says we might drop, today's session would be for you. Check us out. Maybe take a 30-day free trial and come to tonight's event. NASDAQ 100. Also reversal yesterday. Like I said, technology, the worst performing group, worst performing sector anyway. And that led to some underwhelming performance by the NASDAQ 100 as we dropped almost 0.5% yesterday after being up above 18,000. So we had 18,000 conquered intraday. Wasn't that long ago. We broke above the 17,000 level, just another 1,000 points, right? But likely we're going to see close to maybe 350 points shaved off of that at the opening bell today. So we could be finding ourselves back down closer to that 20-day moving average. And again, still slight negative divergence on the NDX, which could lead us down possibly to retest that 17,000 level, maybe even just a little bit below. IWM, small caps, things were looking up. I'm assuming that all of this buying really over the last 5 days, certainly the last 3 days, with increasing volume, I believe that was the market anticipating, perhaps, maybe prematurely, anticipating a really good inflation number and didn't get it. And so all of this strength and relative strength literally being lost at the opening bell. 20-day moving average 195.77, and the IWM right now 195.87. So as we go back and look at that chart, if we open where we are right now, and we've only got about 10 minutes left, literally we're going to open on that on that 20-day moving average. Now, a couple things that I would be watching for here is if it does go below the 20 and the 50-day moving average, we do have a trend line. So you can kind of see, that's probably a little better right there. But we have a trend line, which is down around 192.5. Maybe intraday, we see a tail that goes down there. That would be a $10 drop on the IWM. That would be a pretty big drop. But I would say as long as I still will go back to where I talked about before, I think the 184, 186 area of congestion that we broke out from with heavy volume. I mean, if we're talking about maybe going into some sort or remaining, not really going into, but we haven't taken out this high and we haven't taken out this low, it certainly could just be a period of sideways consolidation. Uptrend followed by a quick downtrend, followed by another uptrend. I believe that that's probably worst case scenario, is that we go down and test this recent low. But you never know. You got to keep your guard up. And like I said, most of this weakness coming at the opening bell. If we rally off of that and finish higher today than we open, then I don't think this day is as bad as the opening bell is going to indicate. But if we continue selling from this opening weakness, that could be a different story and something definitely worth monitoring. Transports, likely to see a big drop as well. I would watch the 20, then the 50. Of course, the big level here on the transports is that double top. Here's the neckline, if you will, off that downtrend. Left shoulder, neckline, head, right side of the neckline, right shoulder, breakout. That neckline breakout occurred at 15.2, and we've been back there and tested it at least 3 or 4 different times over the past 2 months. So things really continue to shake out to the downside. That's the level you've got to watch on the transports. I think that's a very important intermediate term level, 15.2. All right. Later today, Max Payne. Just want to again point that out. You can go right to our homepage at EarningsBeats.com, click on this and register. Not really register for the event, but by coming to the event and registering for a 30-day trial, you'll get kick the tires of EarningsBeats for the next 30 days. And this could be a really important 30 days, by the way. One more big inflation report, and the March Fed meeting coming up. What's the Fed going to do? I think they're going to just hold where they are. I don't believe we're going to get a rate cut. I was not really in that March camp to begin with. I thought it was an outside possibility, but I think it could be more like June. The Fed has indicated they're in no hurry. Maybe it's a mistake to take them at their word, because who knows what they're going to say at the next meeting. But if we do take them at their word, I think they're going to need probably continuing. I don't think we're going to be at 2% in the next 1 or 2 readings. I'm talking about 2% on the target inflation rate. But I think the Fed probably wants us to get closer and closer to 3. And right now, with today's print, instead of the 3.7 that we were hoping for, it remained at 3.9%. That was the annual core rate of inflation at the consumer level, core CPI. So 3.9, didn't see any improvement. Market was expecting improvement. And I think the market was maybe even expecting for a positive surprise. So all of that went against the market this morning. That's why we're seeing the lower prices. And like I said, it's going to depend on how we trade during the day. I think from this point, with the news that we just got, the intraday trading, the intraday rotation is going to be important. And honestly, as much as I believe that the IWM small caps are going to have a good year, I think this pushes it back. Similar to back in 2022. Remember in June, I called the market bottom. We went up, had 700-point advance on the S&P 500. Looked like I had nailed the bottom to the day. Fed came out, made some comments at that point about more pain ahead, if you recall. We went all the way back down. Actually, it delayed the inevitable. We did bottom, but it wasn't all the way until October of 2022. I see something similar happening here. And the reason I say that is once rates start coming down, I think that is a tremendous environment for the small caps, especially for the banks, which are the most heavily represented in the small cap area. So I think this delay is probably going to cause some angst in the small cap arena, but let's see how much. This might be an opportunity for more folks to pour in, and maybe we see that group bounce right back. That would be the most bullish case, is to see the gap downs and see a rally off of that. All right, so I don't even have a chart of the day. So what we're going to do, I didn't even have time to look for one. So we're going to go into the dashboard. Actually, I'll tell you what we'll do. Let's do the biggest move down in scooter for the large cap. I haven't even looked. So the biggest move down yesterday was the MSI. So let's take a look at MSI on the chart and just analyze it. Well, looks like we got a triple top. Looks like we certainly rolled over here and moved back to the moving averages. We did get a big breakout here. I do want to look at a couple different charts. Let's take a look first at the weekly. Divergence still okay. It looks like maybe that 20-week moving average, 310, we're just below. Seems to me like it's pretty good support. Let's take a look at the relative chart and the AD line. AD line has still been strengthening. I think we're okay there. Relative strength is just so-so, and this is in the telecom group. Telecom, not a great group. So we've got an average performer and an underperforming group. So that makes me a little weary, probably not too overly excited about jumping into a stock like this when we have so many others potentially that could look pretty good after a pullback. So I wouldn't do anything with this one. It's not a trade for me, but I would say looking at it, 308, 310, somewhere in this range right here. Even though you lose the 50-day moving average, a lot of folks would look at that as a big breakdown. When you stretch it out to a weekly chart, that's simply 310. Now you see we're at 311 and change right now on the 20-week moving average. This is a big moving average on the longer term chart, the bigger picture. If you go back to the last big move that we made, we're sideways consolidating. We broke out. And after we broke out, any move down to the 20-week moving average was a buy. So here we are, sideways consolidating. We break out. If we go down here, we're hitting price support and the 20-week moving average. That would suggest to me it's a buy. If it doesn't hold up, fails to hold support, you get out with not a whole lot of damage to the downside. Again, I think there are probably other trades out there that I like more, but just quickly off the cuff, taking a look at Motorola Solutions, MSI, that's what I see. All right, last thing I want to do is just look at the relative strength of industry groups over the last month, because these are the groups that are overbought. Many of these groups are going to be groups that have stocks with a lot of in-the-money call premium, because these groups have been going straight up for the last 30 days. This is the relative performance to the S&P 500. This doesn't mean, this is semiconductors, by the way. This doesn't mean semiconductors went up 13%. It means semiconductors went up 13% more than the S&P 500. So we already know the S&P went up through 5,000 and set new all-time highs. These are the groups that are leading this push. Semiconductors, truckers, gambling stocks, internet, marine transportation, diversified or industrial suppliers, specialty retail, broadline retail, specialty finance, airlines. These are all that's probably the top 10 or so of the groups that have led this rally. I have a feeling, I was kind of hoping that we would go right into 930, because I think if we look at an intraday, some of these charts might not be so good. I have a feeling some of them probably are taking a big hit at the opening bell. I would also think that banks, I'm trying to look to see where the banks are right now. They haven't been very strong. Was really just the last few days that we saw the banks moving up. There we go. Kind of in the middle of the pack, actually underperforming the S&P 500 over the last 30 days. But the strength that we saw in that group the last maybe three days, 3 to 5 days, I would say we're probably going to take a pretty big hit in that area. So it is 9:30. Let me see if I update this, what happens. All right, things have changed. All of a sudden now, semiconductors instead of 13% are now 11%. So we just lost 2% to the S&P 500. So if the S&P 500 is down 1.5%, that means semiconductors are down about probably 3.5% or more. So let's take a look first at that group. Down 3% right now. Let's take a look at the IWM, see if that 195.56. It opened above the 20-day, currently trading just below. This could be that morning weakness that we're seeing. Let's see if we get that rebound today. That's going to be an important thing to look at. Otherwise, if we don't, I think we're mired in, best case, probably mired in sideways consolidation. And, I'd probably say that's my worst case as well for now until I see a breakdown. I have to see a breakdown. And again, that to me would be that 184 to 186 range, but even closing down below 187.5 would be a short-term breakdown. But I think the more intermediate term that I would be watching is all of this support here and the breakout out of that range. Let's take a look at banks, because I do think banks are likely to get hit from this. Gave up all of yesterday's gains, basically only down about 1%, though. That's not too bad. Considering we're still holding on to yesterday's low. I'd like to see the banks rally from here. Also, the IWM, I'd like to see a big rally from here. Another group that impacts the IWM is the XBI, biotechs. They were down a lot earlier, coming back. But we are literally at 9:32, folks. Next half hour, 45 minutes, even an hour, going to be really interesting to see whether or not we've already hit our low or if we continue to take a little bit of a dive this morning and then possibly rally back after that. Quick look at the major indices. You can see the Dow now down 337 points. That is less than 1%, though. S&P 500 down 1.3, NASDAQ down 2%, and there are your small caps leading to the downside. Whether or not that changes, I don't know. We'll find out. We do have the VIX jumping about 5.3% back up above 14, getting close to the 15 level. I think if we do see this typical late February, early March move to the downside, I think the VIX could hit maybe as high as 17. That's what I would be thinking is maybe the upside on the VIX. But let's see how it all plays out today. Can't predict, just like we couldn't predict what was going to happen with the inflation report. We certainly can't predict what's going to happen intraday today, but that will be of pretty big concern to me. Anyway, that's it. I'll be back tomorrow for your next Trading Places Live. We'll be able to take a look at the rest of the reaction to this inflation report tomorrow morning. Hope to see you there. Happy trading, everybody.